Welcome to the research desk. Back in January of 2025, Tesla it was printing new highs almost daily.
Oh, absolutely daily. If you pulled up the charts, they looked completely, utterly flawless.
Flawless. It was this masterpiece of market momentum. Every financial network was broadcasting the triumph, and retail investors were heavily leveraging their portfolios.
Right, and the institutional money was just firmly entrenched. Everyone was making money. Until they weren't.
Exactly, because less than 48 hours later, the bottom completely fell out. The price action violently fractured, trapping billions of dollars in debt equity.
Yeah, it was a bloodbath. Which really forces the central question today. Why do the most beautiful upward curves in finance almost always end in violent crashes?
Right, and it comes down to a fundamental misconception in modern finance. The numbers flashing in green and red on our screens, they create this really dangerous illusion.
They absolutely do. They trick us into believing that price is a discrete location, right? Like it's a simple, static number representing the present value of a company.
But it's not. Price is a trajectory moving through liquidity space. Its stability, its future, and its inherent risk do not depend on the number itself.
No, it depends entirely on which mathematical derivative of motion currently dominates the trading tape.
Exactly. So today we are applying what we call the calculus of bubbles to the market. We're translating the physics of motion, position, velocity, acceleration, and jerk, into the direct geometry of asset pricing.
And this is so critical because when you understand these geometric orders, you stop reacting emotionally to market surges.
Right, you start capturing massive momentum structurally. You ride these parabolic moves, not with blind hope, but with cold mathematical precision. You learn to see the geometric derivatives underlying the asset.
And I have to stress this immediately, the exact same geometry that creates those generation-defining fortunes also masks extreme structural fragility.
Well, sure, there's fragility, but the math...
The math of geometric motion does not merely show us where a stock is heading, it shows us precisely how close the underlying engine is to catastrophic failure.
Okay, but understanding the velocity is how you harness it.
I'd argue momentum is inherently deceptive. The parabolic surges that you view as structurally sound are almost always death traps disguised as breakouts.
A death trap? That's a bit hyperbolic, isn't it?
Not at all. Look, when we measure acceleration, what we call order 2 in this framework, we aren't just measuring upward trajectory. We are measuring structural stress.
Right. The gravitational forces pulling on the asset.
Exactly. We are looking at a system pulling extreme G-forces, drawing in highly leveraged capital, and silently hollowing out the liquidity beneath it. What looks to the untrained eye like genuine strength is often just illiquidity mimicking convection.
Well, to understand how we actually capture that velocity and why this framework demands such strict adherence to mathematical reality, we have to strip away the complexity. We need to start at the absolute baseline.
Which is order 0, the parked car.
Right. Think of the market through the physics of a car. There are 4 distinct layers of motion, and the foundation is order 0. The engine is running, the keys are in the ignition, but you are completely stationary.
And in the calculus of the market, this occurs when a stock is hovering right near its 200-day moving average.
Correct. To be precise, we look at the sigma distance. For anyone listening, sigma distance is simply a measurement of how far the stock has stretched, like a rubber band, away from its long-term average price.
And in order 0, that rubber band is entirely slack. The sigma distance is less than 1.0.
Yeah, the volume traded every day is entirely unremarkable. Volatility is crushed to an absolute minimum, and the stock just sort of drifts sideways.
It's the seed phase of market action.
Exactly. The narrative is beginning to form in the background, but it hasn't yet translated into price motion. Consider Bitcoin in early 2019, sitting around $3,000, trapped in the depths of a brutal crypto winter.
Right. The broader financial world had confidently declared the asset dead and just moved on.
But underneath that stagnant price, the infrastructure was being quietly built. The foundational code was advancing. Institutional custody solutions were being drafted.
So the price was heavily anchored, but the engine was running.
Precisely. The geometric risk here seems non-existent because there is zero velocity. But understanding order zero is critical because it tells us exactly where the launch pad is.
A launch pad, sure. But a parked car is not inherently safe if it's parked in a deteriorating environment. You call order zero a launch pad, but you really must recognize the hidden, silent risk embedded in this phase.
The opportunity cost?
Worse than that. The risk isn't a sudden crash. The risk is permanent stagnation. If the narrative is entirely consumed by the market before the price ever moves, that launch pad becomes a graveyard.
I mean, that happens, yes.
Imagine a biotech company that discovers a novel compound. The story gets out, medical journals publish the findings, analysts model the future revenue, but the stock stays flat.
Because the market has already digested the fundamentals.
Exactly, they've digested it, and still nobody is stepping in to buy. When that happens, that 200-day moving average stops being a supportive anchor and starts acting like a concrete ceiling.
Right, the base silently erodes from underneath you, but that's why we don't blindly trust a flat line.
Right. Investors trapped in order zero often suffer from a severe opportunity cost. They hold dead capital for years, constantly convincing themselves they are simply early to a revolution.
While the rest of the market compounds wealth elsewhere. I agree completely. You have to wait for the math to prove that the narrative is actually catching fire with institutional buyers.
You need verifiable mathematical velocity.
Exactly. And that transitions us into order one. The car finally shifts into drive. You reach cruising speed.
Cruising speed, where the slope is clean and the acceleration is zero.
Yes, the accelerator is pressed and the car moves forward at a constant, highly predictable rate. Order one is the steady state of momentum.
And mathematically, how are you defining that state?
We calculate a 60-day linear regression, which is really just a mathematical way of drawing the most accurate straight line through the last 2 months of price data. We see a clean, positive slope.
But crucially, the quadratic coefficient remains near zero.
Right. Let me translate that for the listener. The acceleration is zero. The stock is moving up, but it is not speeding up. It's steady speed. Sentiment velocity is perfectly matching price velocity.
Like Meta in mid-2023.
Perfect example. Mark Zuckerberg had just declared the year of efficiency. The company was slashing bloat, redirecting focus, and the market just loved it.
If you look at the chart from that period, the slope of the stock was almost perfectly stable.
Exactly. It wasn't wildly spiking, it was marching. Volume was rising systematically. Portfolio managers at massive institutions were entering the stock in measured, careful tranches over weeks, not days.
Wall Street analysts were upgrading their price targets in a synchronized cadence.
Every single trading week looked remarkably similar to the one before it. The stock was driving down an open highway at a constant 60 miles per hour. This is the institutional sweet spot. Sure, you can deploy substantial capital there without losing sleep. Exactly. A right-side hold of 3 to 8% of a portfolio is completely justified because the trend is mathematically confirmed by steady volume, the geometry is exceptionally stable, you're making money, and the ride is incredibly smooth.
I hear you, but order one only feels safe. And that feeling of safety is precisely its danger.
Danger? In a perfectly linear upward trend?
Yes. A steady, predictable slope creates a powerful psychological anesthesia for investors. It induces the false confidence that the trend will last forever.
Well, investors always project current trends into the future. That's human nature.
Right. They look at a chart moving predictably up and to the right at a constant velocity, and their brains naturally project that straight line out into infinity. They stop actively managing their risk.
Because the day-to-day volatility has been temporarily engineered out of the price action.
Exactly. But a constant speed in financial markets is a deeply unnatural state. Think about the mechanics required to maintain that perfect 60-degree angle on a chart.
It requires an equilibrium.
A perfect, uninterrupted equilibrium between aggressive institutional accumulation and willing sellers providing exactly enough liquidity to absorb that demand. And the moment that delicate equilibrium shifts,
the car doesn't just stay at cruising speed.
Right. It faces a binary outcome. It either brakes violently due to exhaustion, or worse, the driver loses patience and floors the accelerator to chase the dwindling supply of shares.
And that transition, when the steady linear trend breaks upward into a sharp curve, That's where we hit order 2.
Where the real danger begins.
Or the real money.
Flooring the accelerator transitions us directly into order 2. This is where the mathematics of the parabola take over the tape. The quadratic coefficient begins to completely dominate the linear slope.
Yes, the measurement of how fast the speed itself is increasing takes over. Our acceleration ratio breaches the 0.5 threshold, and that rubber ion we talked about, the sigma distance, pushes well past 1.5.
And it just keeps stretching.
The car is no longer just moving forward, it is moving forward faster and faster every single day. 60 miles an hour becomes 80, then 100, then 120.
In the market, we call this liquidity acceleration.
Exactly. This is when leverage enters the system in mass. Retail traders buy out-of-the-money call options, forcing market makers to hedge by buying the underlying stock.
Which pushes the price even higher. It's a feedback loop.
A massive feedback loop. Short sellers are squeezed. They are forced into absolute capitulation, buying shares at any price just to cover their deeply unprofitable positions.
Adding massive synthetic demand to the upward pressure.
Every minor intraday dip is bought within hours. A 5% drop is immediately dismissed by financial commentators as a healthy pullback.
Bear cases are openly mocked on social media.
Oh, constantly. But listen, this is the zone where genuine, life-changing fortunes are made, provided you deeply understand the structural integrity of the move.
If there is any structural integrity left.
There often is. Look at NVIDIA throughout 2023 and 2024. It sustained order 2 acceleration for a staggering 18 months.
18 months in a parabolic state is an extreme anomaly.
But it happened. So how does a massive company survive pulling those extreme G-forces for a year and a half without the engine exploding? Think about this for a second. The answer lies in the fundamental architecture.
The gravity walls.
Exactly. The 4 gravity walls, revenue growth, margin expansion, forward guidance, and institutional cash flow, all remained violently green.
Violently green? Sure, but
Let me explain how those walls function first. When the stock stretched incredibly far from its historical average, the actual underlying business was generating so much cold hard cash that it pulled the fundamental value up to meet the soaring stock price.
the underlying economic reality kept pace with the extreme geometry.
That is the ultimate triumph of the bull case in order 2. When the fundamentals accelerate just as fast as the price action, you hold on and let the mathematics compound your wealth.
Okay, but the NVIDIA example is a beautiful story. It is also the siren song that leads millions of everyday investors to their financial slaughter.
Slaughter is a strong word when we're talking about verifiable momentum.
I'm using it intentionally. You are pointing to the rarest of historical exceptions, a once-in-a-decade technological monopoly, and treating it as a standard expected outcome for rapid growth stocks.
Not standard, but structurally possible.
I want you to picture order 2 differently, away from the sterile math of coefficients. Imagine a massive suspension bridge spanning a deep canyon.
Okay, a suspension bridge.
From a distance, as you approach it, the geometry is visually breathtaking. The curve of the suspension cables is perfect. The structure appears intact, majestic even.
But up close?
Walk out onto the center of the span and look closely. The massive steel cables holding the bridge up are pulled incredibly taut. They are groaning under the immense multiplying weight of the traffic crowding onto the center.
Meaning the structural stress is at its absolute theoretical limit.
Exactly. Every dip is bought, yes. Bears are laughed at, yes. But that aggressive buying behavior is a symptom of extreme margin leverage and retail euphoria, not structural soundness.
You're saying the buyers are exhausted?
Completely exhausted. But the momentum forces them to keep adding weight to the bridge. So what actually happens when you hit order 2 acceleration without those miraculous fundamental gravity walls you mentioned? Think about this for a second.
You're going to bring up Cambricon, aren't you?
Look at Cambricon Technologies in late 2024. Cambricon went from order 0, parked peacefully at its moving average, to total catastrophic collapse in just 8 months.
Right, an 8-month life cycle.
8 months to build the bridge, crowd it with leveraged traffic, and watch the entire structure snap in half. There were no green gravity walls to anchor the acceleration.
Revenue wasn't quadrupling?
Margins weren't expanding. It was pure, unadulterated momentum, feeding entirely on its own geometry. Traders bought simply because the stock was going up,
which made it go up faster.
which made more traders buy. Relying on an NVIDIA scenario to justify holding through parabolic acceleration is relying on a statistical outlier. Order 2 is not a comfortable place to compound wealth. It is a blaring warning siren.
So what's your operational rule there?
The strict operational discipline here is mandatory staged exits. When that acceleration ratio crosses 0.5 and the curve goes vertical, you take 10% off the table for every 5% rise in price.
No exceptions?
No exceptions. You do not add leverage. You do not buy the dip. You recognize that the bridge is at maximum tension, the cables are groaning, and you slowly walk back towards solid ground while everyone else is rushing to the middle.
Okay, I will actually concede that Order 2 requires rigorous unemotional discipline. Your staged exit rule is mathematically sound for preserving capital.
Thank you.
But to truly apply this framework, we must accurately define the catastrophic failure state itself. What exactly happens when the bridge snaps? This brings us to Order 3.
The brake failure.
Exactly. To return to the car analogy, this is the moment the brakes fail, the steering column locks, and the vehicle flips violently off the road.
And mathematically, this is the jerk.
Right. The mathematical calculus term for this phenomenon is jerk. It is the third derivative of motion, which measures the rate of change of the acceleration itself. It's not just that the stock is dropping.
It is that the speed of the drop is accelerating exponentially. The jerk is where the physics of the market become genuinely terrifying.
Because the math completely shatters.
Entirely. We are no longer dealing with smooth curves, predictable moving averages, or standard regressions. We are dealing with violently discontinuous price functions.
Intraday reversals violently exceed 5%, then 10% from the 20-day high, often within minutes.
You see massive gap downs at the opening bell that instantly trap everyone who confidently bought the previous day's minor dip. Trading halts trigger across the exchanges as volatility circuit breakers are tripped.
And the trading volume explodes, but it is entirely exclusively on the selling side.
Right. Why does this physical fracture occur in the market? Think deeply about the microstructure of a stock exchange at extreme acceleration. Picture an auction house.
Okay, an auction house during Order 2.
During Order 2, a parabolic straight-up rise has systematically consumed every marginal buyer in the ecosystem. Everyone who could possibly be convinced by the narrative has placed their bids.
The room is full, but nobody has any cash left to raise their paddle.
Exactly. When the very last buyer enters the stock, a critical threshold is silently crossed. The bid side of the order book, the list of people willing to buy shares at the current price, doesn't just slowly thin up.
It completely evaporates.
It becomes a total vacuum. When the first major wave of institutional profit-taking hits, or the first piece of mildly disappointing news drops, those large sell orders do not execute against the thick wall of willing buyers.
They hit empty air.
They hit empty air. The price falls straight down, skipping dollars at a time until it hits the next tiny pocket of resting buy orders.
And when the price plummets that fast, it immediately triggers the automated stop losses of the late retail entrants who bought at the peak.
Right, and those stop losses automatically convert into market sell orders, which flood the system and hit even more empty air. It is a catastrophic cascade of mathematical discontinuities.
The bridge cables don't just fray, they snap instantly, and everything falls into the canyon.
Look at Peloton's 96% drop starting in late 2021. The momentum was purely narrative. It was driven entirely by the unique liquidity environment of a global lockdown.
And when that narrative fractured, the bids simply disappeared.
The auction room emptied out. Look at Tesla in January 2025, which you brought up at the start. The operational fundamentals of the company were still present. They were still building cars, but the narrative fractured under the sheer, unsustainable weight of its own geometric acceleration.
The moment you detect the mathematical signature of Order 3, the asset is radioactive. I will not debate you on the absolute toxicity of Order 3.
You can't. The math is undeniable.
When the third derivative spikes and that drawdown brutally breaches 10% from the recent high, the only acceptable action is a blind emergency exit. You hit the bid and you get out.
No averaging down to improve your cost basis.
None. There is no buying the dip because you believe in the long-term vision of the CEO. The survival mechanism of this entire geometric framework relies entirely on detecting the structural stress during Order 2. long before the catastrophic fracture of Order 3 ever materializes.
Which is exactly why you have to constantly monitor the mechanics.
But to do that effectively, to truly master the calculus of bubbles and avoid being shaken out of genuine wealth-building trends, we have to recognize a nuanced reality.
That not all velocity is created equal.
Exactly. The geometric framework received a groundbreaking refinement with the 2026 Gerard and Jehl study published in the Financial Analyst Journal.
Ah, yes, the FAJ paper.
Prior to this paper, quantitative analysts looked at Order 1, that steady cruising speed we discussed, and treated all linear momentum as identical. If the slope was positive, the math said bye.
Right, a very simplistic assumption.
Gerard and Jehl dropped a bomb on that simplistic assumption. They proved mathematically, by analyzing decades of global trading data, that Order 1 momentum stems from two entirely different underlying sources.
And identifying the exact source of momentum dictates whether the trend will survive or collapse.
Exactly. The prime catalyst for the bull case is what they termed earnings-driven momentum.
Which is incredibly specific.
Very specific. When a stock's Order 1 upward slope perfectly coincides with a genuine fundamental earnings announcement, say, a massive surprise in top-line revenue, structurally higher profit margins, or significantly raised forward guidance,
The market fundamentally underreacts to the news in the short term.
right. This phenomenon is known as the post-earnings announcement drift. The critical, undeniable finding from their extensive study is that this specific stock-level momentum never reverses in the long run. Let me emphasize that. It never reverses.
You're calling it permanent velocity.
It transforms into permanent velocity. It is the real-time manifestation of the massive global market taking weeks or even months to fully digest genuinely new, fundamentally altering information about a company's intrinsic value.
Okay, but what's the practical application of that?
The practical implication for our framework is massive. If our mathematical system flags a trend-wise crossover, which is our clearest algorithmic buy signal, and that specific signal occurs within 10 trading days of a verified earnings catalyst, we do not cautiously tiptoe into the position.
You deploy full thighs.
We deploy full size. We trust the geometry implicitly because the underlying fundamental catalyst mathematically guarantees the permanence of the velocity.
Okay, you focus intently on the permanent velocity, but you are casually sidestepping the massive bear trap that the exact same study illuminated.
The factor rotation trap?
Yes, Gerard and Jehl proved that while earnings-driven momentum sustains itself, factor-driven momentum always reverses, always.
Well, macro tide shift. Sure.
It's more than a shift. Factor momentum is a byproduct of sector rotation. It is style rotation. It is the massive blind flow of macroeconomic capital shifting entirely from risk-off assets to risk-on assets.
Or rotating completely out of energy stocks and aggressively into technology stocks.
Exactly. When an entire sector rises simultaneously because institutional money is rebalancing, the momentum of any individual stock within that sector is not a reflection of its specific corporate fundamentals or its brilliant management team.
It is borrowed velocity.
Borrowed velocity. The stock is simply being carried higher by the rising tide of passive ETF flows and institutional basket buying. Let me translate what that means for the retail investor.
They misinterpret the chart. They do. Most investors look at a rising chart in Order 1. They see that steady, 60-day linear regression pointing up. They see their moving averages perfectly align.
And they assume genuine idiosyncratic strength in that specific company.
Exactly. They are mathematically correct about the shape of the geometry, but they are completely wrong about the physics driving it. They are relying on borrowed velocity.
Because once that broad macro-sector rotation stops,
or shifts its focus to a new target, that borrowed velocity instantly dies. The rising tide recedes. The stock will abruptly reverse course, violently wiping out all the late entrants who thought they were buying a breakout.
so you can't just trust Order 1 blindly.
No. Relying purely on the geometry of Order 1 without forensically verifying the source of the momentum is reckless behavior. It is driving a car fast just because the wind is temporarily at your back.
That's a fair point.
If a stock's trend-wise crossover happens in sympathy with its broader sector ETF, with no isolated earnings catalyst to fundamentally justify the inflection, the velocity is contaminated. You cannot assign high conviction to an asset that is simply riding the coattails of macroeconomic flows.
But that crucial distinction between permanent and borrowed velocity is exactly why the modern geometric framework is vastly superior to traditional chart reading.
Superior if applied correctly.
Right, we don't just look at the line anymore. We filter order one. We demand to see the earnings catalyst before we trust the cruising speed. But we also have to address the second major twist in the recent quantitative literature.
Ah, you mean the Jehl and Kim study?
Yes. Because this fundamentally alters how we perceive that dangerous parabolic acceleration in order two. The 2026 study by Jehl and Kim isolated a critical, systemic vulnerability in machine learning portfolios and algorithmic trend capture.
They called it the Microcap Illusion.
They did. They proved that the physics of market liquidity change entirely based on the market capitalization, the total size of the underlying asset.
The physics don't just change, they actively lie to you.
How so?
The Jehl and Kim study is the ultimate vindication for those of us who demand stress testing for quantitative signals. Think about the raw financial energy required to move a $500 billion megacap stock 3 standard deviations away from its 200-day moving average.
It requires a staggering amount of capital.
Staggering. It takes sustained institutional buying, massive ETF rebalancing, and the genuine, verifiable conviction of tens of thousands of highly educated market participants.
So when you see the geometry of order 2 in a megacap stock, it is built on a foundation of deep, thick liquidity.
Exactly. The market is speaking with a booming, undeniable voice. Now apply that exact same mathematical threshold, that exact same standard deviation formula, to a sub-$2 billion microcap stock.
The math changes completely.
To move a microcap 3 sigmas from its anchor, you do not need institutional consensus. You do not need thousands of participants. You just need a handful of aggressively large market orders executing in a thinly traded order book.
Right. The absolute capital required is timing.
Yes. So the exact same parabolic geometry that signals extreme structural acceleration and fundamental shifts in a megacap is nothing more than pure illiquidity noise in a small cap.
The math lies to you.
Your acceleration ratio breaches 0.5. Your sigma distance flashes bright red. Your charts look identical to the famous NVIDIA breakout of 2023. But the underlying reality is a mirage.
It's just a liquidity vacuum disguised as momentum.
Exactly. A few large traders pushed the price around in an empty room, and your algorithm mistook it for a revolution.
I embrace the Jehl and Kim data completely because it mathematically validates the hard gate architecture of our entire trading system.
The hard gate architecture, right?
Yeah, traditional composite scoring models where a quant aggregates 50 different fundamental and technical factors into a single score from 0 to 100, they fail precisely because they treat a signal as universally additive.
They assume a good signal is a good signal regardless of the environment.
Right. Jehl and Kim proved that certain quantitative predictors actually carry negative importance if they are not strictly gated by market cap. Including them blindly degrades overall portfolio returns.
Which is why geometric order has to act as an asymmetric override to your composite score.
Exactly. Let me explain how a hard gate works for our listeners. If a stock has a perfect composite fundamental score of 95, but it is a thinly traded microcap flashing order 2 acceleration, the system hard gates the entry.
It blocks the trade entirely.
It blocks it. Order 2 in a sub-$2 billion name requires overwhelming supplementary confirmation before a single dollar is deployed.
You demand the green gravity walls of fundamental growth we discussed earlier.
We require an explicitly open trend-wise signal. We demand a recent verified earnings catalyst. Without all of those fundamental confirmations, the microcap order 2 signal is quarantined. We override the composite score entirely.
Order 2 in a microcap means no new positions?
Order 3 means an immediate emergency exit, regardless of how cheap the valuation looks on paper or how compelling the CEO's narrative sounds on financial television. These hard economic restrictions are the only mathematical way to prevent quantitative models from overfitting to the dangerous noise of thin liquidity.
Look, acknowledging the hard gates in a backtest is a start, but executing them in real time requires an operational, psychological discipline that most investors fundamentally lack.
Because human nature gets in the way?
Always. When the screen is flashing green,
Human greed overwrites algorithmic logic. Let us return to the bridge metaphor to make this structural stress visceral for the listener.
Okay, the bridge again.
You cannot just stand on the bridge and wait for the price to violently snap beneath your feet. You have to actively, obsessively look for the fraying cables while the bridge is still standing.
You must constantly monitor liquidity thickness.
Exactly. When a stock is cruising safely in order 1, the order book is a picture of absolute health. The bid-ask spread, the difference between the highest price a buyer will pay and the lowest price a seller will accept, is incredibly tight.
It is deeply symmetric. There are just as many willing buyers resting below the current price as there are willing sellers resting above it.
And crucially, as the price makes new highs, the sheer volume of shares traded increases. The cables of the bridge are taut, but they are thick, strong, and perfectly balanced.
But then you transition into order 2.
Right. Closely observe the microstructure transition into order 2. The geometry on the screen is still curving beautifully upward. The price is hitting new all-time highs, but the internal architecture is decaying.
The bid-ask spread begins to widen.
At the new highs, it noticeably widens. The market makers are stepping back. The trading volume does not confirm the new high. It flatlines, or worse, it actively declines.
And most terrifyingly, the order book thins out on the bid side.
The buyers are quietly exhausted. If the price makes a new high, but the absolute depth of the order book is demonstrably thinner than it was at the previous high, the geometry is literally hollowing out from the inside.
The bridge is still standing, the cars are still crossing, but the internal steel is fracturing.
You are moments away from the disastrous vacuum of order 3.
And that internal monitoring of the order book is exactly why we run the narrative falsification test alongside the math. The math will show you the mechanical hollowing out of the bids, but human psychology is what ultimately creates the vacuum in the first place.
So what are the questions you ask?
We ask 4 rigorous, deeply uncomfortable questions to test the integrity of the math. First, are there any actual new buyers left? Has the story reached maximum saturation in the mainstream financial media?
Right. When your neighbor who doesn't trade is asking about the stock, the auction room is full.
Exactly. Second, does undeniably great news still push the price up? Think about this. If a company announces a massive new government contract or a blowout earnings quarter and the stock opens flat or even fades lower throughout the day, the momentum is dead.
The buyers are completely exhausted.
Third, how many concurrent reasons do the bulls need to justify the current valuation? If the core thesis requires falling interest rates, a major competitor failing, a flawless new product launch, and a macro acquisition to all happen simultaneously and perfectly,
If they need 4 or more distinct reasons to justify holding the stock, the psychological structure is incredibly fragile.
it's resting on a house of cards. And fourth, the most important question, what is the disaster scenario?
If they can't answer that, they're in trouble.
If the market sentiment is so euphoric that you legitimately cannot think of a realistic, plausible disaster scenario that would break the trend, you are completely blinded by the geometry. You have lost your objectivity.
And what happens if you fail this test?
If the honest answers to those 4 questions are no, not really, 4 or more, and I can't think of anything, you are sitting in the lethal acceleration of order 2 or the impending brake failure of order 3.
It doesn't matter how pristine the chart looks.
It doesn't matter what your indicators say, the structure is failing.
So after dissecting the extremes of market motion, we converge on a shared reality, despite approaching it from fundamentally different angles.
I think we do.
You view momentum and geometric velocity as the absolute greatest drivers of outsized returns in the modern market. I do not deny that the raw math supports that conclusion, provided the momentum is structurally sound and fundamentally backed.
Right. We agree on the potential upside.
But the integration of the Gerard and Jehl study regarding permanent versus borrowed velocity and the vital Zhou and Kim study exposing the microcap liquidity illusion absolutely proves my core thesis.
Which is?
Blind faith in chart trajectories without interrogating the underlying mechanics is a fatal flaw.
And I readily acknowledge that to safely harvest that massive momentum, to actually keep the wealth you generate during those parabolic runs, you must strictly, unemotionally obey the hard gate exits.
You simply cannot negotiate with the math.
You can't. Order 2 demands staged exits, systematically capturing the gains while methodically reducing your exposure to the parabolic stress. Order 3 demands an unconditional emergency exit at the market price.
If you respect the fragility of the bridge and constantly monitor the tension in the cables, you can cross it safely and profit immensely from the crossing.
You really can. It just takes discipline.
Which leaves us with the ultimate stress test for anyone listening to this framework. When you look at your own portfolio tomorrow, look past the green numbers on the screen. Ask yourself, are you sitting on genuine earnings-driven momentum supported by deep liquidity? Or are you just borrowing velocity on a bridge with fraying cables? This is the Research Desk officially signing off.